Welcome back, people. My name is Subi.
And my name is Kalen.
And this is Beginner's Luck video number 2.
Dose.
Investing versus trading.
Oh yeah. So here's the long and short of it. Investing is mainly about longer term plays where you're looking to gain equity or ownership of a company so that you can create exponential returns over time. Trading is a much shorter term, riskier play where you're looking for some type of catalyst that's going to make a stock move up or down in the very, very, very near term.
Go on, go again. And an example of investing versus trading is buying a fidget spinner company, which is a really hot commodity, very popular for about 10 seconds.
Right.
Versus getting something like Tesla, which will be hot for the next 5, 10, 15 years because it's one of the biggest electric car companies in the world.
Potentially.
But what is investing? Investing is when you try to get equity or ownership of a company. This is usually done for a very long-term means, for maybe 5, 10, 15, 20 years down the line. And with investments like this, the short term can be very painful because the markets can go up or down, sideways, and you never really know what's going to happen. But it's always nice to remember that if the story of the company never really changes, then you can just stick with it or just use that as an opportunity to buy more stock. Remember, you don't lose or make any money. None of this is real until you sell the stock. Just like we talked about in our first video, compounding is going to be your best friend. This is how you make gains on gains on gains on gains. Some popular examples of investments include stocks like Apple, Google, Amazon, Tesla, McDonald's. If you bought these sorts of stocks on the dip, you would have made thousands of percents on returns. Why do I always start off so fast? But these sorts of investments can only be made when you understand the company. Understanding the company will get you through these downtrends, these spirals, which will let you just buy more in the end. But this is where we have to emphasize that you have to do your own research. You have to understand the company you're investing in. So here are a few questions you can ask yourself when investing. What?
I'm sorry.
What do you want?
Just so quick.
A few questions you have to ask yourself are, where do you see the world in 5, 10, 20 years from now? And also, where does your company fit into that? So for example, if you see the world going towards a more green energy kind of society, then you'd want to be invested in solar companies or hydroelectric companies that specialize in these sorts of fields. Asking these sorts of questions lets you evaluate what the company is. Unless you really...
What the fuck? Why are you saying this? Where is this coming?
Asking these sorts of questions... I can't. You gotta... You gotta get to laugh. Bro, you gotta get out of here. I can't do this anymore.
Somebody give me a napkin.
You're just not serious enough. Asking these sorts of questions will let you really evaluate the company without having to be an expert in the industry. This will give you a better idea of what their future growth can be. There are 2 main ways that investments are made. The first is known as lump sum, where you take all the money available to you and you buy all the stock at one time. And the second is known as DCA, or dollar cost averaging, where you periodically buy more of the stock over time. However, according to Vanguard, one of the largest index fund companies, lump sum outperforms DCA 66% of the time. But investing isn't the only option you have. You also have trading.
Come on, bro.
I can't look at you. Action.
So what is trading? Trading is all about short-term moves. It could be something like a day trader, which is trading on a minute-to-minute basis, or even a week, month, or up to a year. Usually it doesn't go too much longer than that though. So the biggest difference between trading and investing is the way that it's taxed. So there's long-term capital gains tax, which is for anything that you hold for over a year. And then there's short-term capital gains tax, which is for anything that you've owned less than that. So long-term is taxed at either 0, 15, or 20%, depending upon your tax bracket. Short-term capital gains tax is taxed purely as income. So let's say you made $45,000 from a job that you worked that year, and then you made $5,000 from trading. That $5,000 would be your $45,001 to $50,000. And so it would just be taxed just like any other dollar that you made that year. So how do people decide to trade? One category of traders are day traders. They make moves on a minute-to-minute basis, and it's usually all based on technicals, which are just a bunch of lines and arrows on a chart. They get in and out within minutes, sometimes even sooner. Another category, which is a lot more popular amongst professional traders, is people that are trading based on macroeconomic analysis, which is really just looking at the whole world and trying to figure out what the heck is going to happen over the next 6, 9, 12, or sometimes even up to 18 months. An example of this analysis would be something like oil over the past 12 months. Professional traders look at it and see that supply and demand are intersecting at a much higher price point. So realistically, you want to buy for the future, but they're not looking to buy for 2 or 3 years from now. They're looking to buy for 6, 9, or maybe 12 months from now. Bro, shut up. Shut up. So we do want to highlight the difference between kind of your bang average trader, or even your institutional trader who's trading with millions of dollars, and the day trader who's in and out of positions within minutes or even seconds sometimes. Day traders are very, very unlikely to be profitable over pretty much any period of time. Whereas with the institutional trader, although it's completely dependent upon the person, because they give themselves a longer period of time to actually make these plays, they have a built-in buffer for things to work out. In a study done by CNBC, they found that only 3.5% of day traders are profitable at all over a short period of time. Of course, trading can be extremely profitable, but that's only if you're doing your research. If you don't do your research and you're just YOLOing into things, then there's a very, very high chance that it's not going to be profitable. One of the earliest forms of trading is making a bet on a company's earnings, which is a report that a company comes out with 4 times a year that pretty much just tells you all about their financial situation and where they see the company going in the future. So the way this would work is pretty simple. Let's say a company is reporting their earnings on March 15th, right after the market closes. And you think that this earnings report is going to be great. They're really going to blow it out of the water. You'd want to buy that stock some point on March 15th, and then you'd be looking to sell it when the market opens on March 16th, hopefully for a profit. So now you've learned a little bit about trading, and you've learned a little bit about investing. But which one is right for you?
Being an investor versus a trader has gotten to be more and more about status, especially during the pandemic.
Absolutely. And the kind of cold hard truth of it is that the smartest and richest people in the world are both.
Right.
These are people that want to make money. And so if they see inefficiencies in the market where they can take advantage of it, sometimes even over a day, then they'll do it. They'll go for it because they want to make the money.
Right. And if they see a long-term investment, they see McDonald's in the 1980s and they have the money for it, they'll get into it early.
And they'll stay in it.
Exactly. And then they'll make all the money and then they'll reap the benefits.
Absolutely. So the biggest thing is really doing the right thing for the moment.
Yeah.
Right?
Yeah.
Whatever you see, whatever opportunity you see, it's trying to capitalize on it.
Like for me, I'm more of an investor, but I also do some more trades. Whereas Kalen...
I'm a little bit more kind of clued in on a normal basis. So
Right.
A lot of times I absolutely have my long-term investments, but I try to take advantage of things where I can be in for 3 months or 6 months. And because I'm not some gigantic hedge fund, I can be really, really nimble and get in and out when I want.
Right. So you have to do what's best for you.
You got to play your situation.
So in the end, forget about labels, forget about status. In the market, you only have one goal, which is to make money.
That's it. Period. End of story. That's the long and short of it.
Exactly. Which brings us to our next video, being price versus value.
You got to know when to buy a stock, right?
You got to know when to hold them. You got to know when to fold them. So we'll see you guys next week.
Take care. That was good.